Hola, para comenzar, déjeme en mi limitado portuñol agradecer sobre todo pelo convite para estar aqui, por poder estar en Cartagena, que é tão bela cidade, mas também para agradecer a FLAR e a CAF por serem duas instituições com que me dá muito prazer colaborar pela admiração, pelo trabalho que têm feito há tantas décadas. E por fim, a governador Velarde, que é um exemplo não para toda a região, mas também para o mundo, pela sua sabedoria e pela doutrina que está criado durante seu tempo no Banco de Peru. With that, let me move to English, also for respect for our non-Spanish speakers in the audience, and to tell you about the topic that I brought to you today. So I want to talk about financial repression for the next 30 minutes. Why do I want to talk about that? I don't need to review the events of the last years, if not even more intensely the last few months, which have been marked by, of course, the very large increase in tariffs in the bottom left plot there, straight from when they were first announced by President Trump, and which by now are completely out of date, in that every week they move out of date, but which itself shows you the trade wars with not just a level, but especially a volatility that comes with them. I do not need to tell you about the rise of industrial policy that predates the trade wars and had been going at least for the last 5 years, if not more, or as the plot on the top right shows, often under the heading of green policies. The fact is that we have seen quite a trend of increase in aggressive industrial policies with domestic national interest always at their heart and as their goal. And finally, also well before President Trump in the US, the increasing geofragmentation in the world. There in that plot of showing how not just recently, but as well as before, we have seen a reversal of a trend towards increasing trade integration at the global level, towards now a segmentation in the last few years, and which is expected to continue. So we have industrial policy for a while, national interests, a return to mercantilist views, trade wars, fragmentation. What will come next? Some of the other speakers will talk about some of these. I want to focus on, instead, try to be a little forward-looking perhaps, and think about whether financial repression is the fourth element in this slide that would fit into the 2x2 matrix and the one that is right ahead of us. But to do so, we need to think about what financial repression is. Financial repression is a term that is used in general and often loose and undefined terms, because it sometimes refers both to tools or instead to the effects of policies. When it comes to tools, going back to the classic work of McKinnon and Shaw in the 1960s and 70s, we think of financial repression as a combination of 1, controls on international capital flows, and 2, strict regulations over domestic financial intermediaries. It is a combination of, on the one hand, countries closing between themselves to avoid being influenced by the capital flows that were seen as perhaps destabilizing their economies, or simply for a desire for a certain independence, often always motivated by protectionist goals, as well as large and deep regulations over domestic financial intermediaries that affect the allocation of credit with, again, sometimes better and sometimes worse objectives. But the term financial repression is instead often stated in terms of its effects. Repressed interest rates, a distorted allocation of credit, and if you look at the more modern literature, as exemplified by the classic book by Carmen Reinhardt and Ken Rogoff, when they refer to financial repression, they refer instead to indicators of some repression, as seen through what seem as distorted relative prices, as well as allocation of credit within an economy. I want to start this talk by, as promised in the title, bring a little bit of clarity in terms of what financial repression is, through a definition that I think will be helpful in guiding your thoughts. I have found it helpful to guide my thoughts, and which hopefully will give fruit even over the next 30 minutes as I use it. To do so, allow me to introduce
a little bit of math. Don't worry, it's early in the morning, I won't do too much of it. But really just what I will be doing is not economics per se, as it is simply accounting. The math is here just to make sure that nothing is left out. What is the deficit in an economy? Well, if I think of the market value of the debt, by which I mean all the different composition, different maturities of public debt issued by a government, its change, written there again as DB, but I will only use English in my words. You just have the math there. So if you don't look at math, just look at me and you don't have to do that. The deficit, in other words, the increase in the debt in an economy, is the sum of two components. The first one is the primary deficit. That is, to what extent the surplus in the accounts of the economy, of the government, is negative, leading therefore to increase in borrowing in order to pay for the excessive spending over revenues. And secondly, it includes the payments on the debt, which are equal to the interest paid on the debt times the quantity of that, but where, insofar as we think about debt and all of the variables, including surplus, as a ratio of GDP, also subtracts by the growth rate of output and of GDP in the economy, diluting the debt in terms of the common denominator, it being GDP. Now, if that is a simple accounting identity, there is one piece of economics that is important, and that is that someone has to hold that debt. There have to be investors, bondholders, domestic or international, that choose to hold that debt. And the really only important consideration in the choice of that holding of debt is to what extent they will be willing to pay for it and hold it while discounting the future revenues and whatnot that will pay for that debt. In many ways, as modern asset pricing has taught us, what we really need to think in terms of the holders of the debt is what their discount rate is. At what point do they trade off the current payment for the debt for discounting the stream of future payoffs and dividends and whatnot that that asset will hold for it. What that economic assumption implies is that that simple accounting flow identity leads to the following inevitable, unavoidable conclusion, or other way of writing that same law of motion for the debt, which is that the market value of the debt minus the present value of the primary balances. So now thinking about the market value of debt today, I call B0. We're looking now at the present value of all of these primary surpluses between today, tomorrow, and all future periods, okay? The difference between those should be equal to a mysterious term. Now, that mysterious term is often said to be zero. Why? Because the difference between the market value of the debt and the present value of the surplus must be zero, since the debt is backed by the surpluses. There's nothing else in a government but the surplus it generates from the perspective of the bondholder. And yet, this question mark term, which is, let me say it in abstract terms what it is, in arithmetic terms what it is, because all I've done is arithmetic so far, is the present value of the debt that the government will have and has at any point in time, times the difference between the discount rate of the investors and the interest rate paid by the government. Okay? Why is this term often set to zero? And why is it that in your classes in economics you've always, and traditionally in textbooks, is set to zero? Because often it is assumed, stated, if your teacher is a little better, discussed, that, well, the bondholders are discounting the debt at the same rate that that debt pays. M is equal to R, and that term has to be zero. Okay? Often circular arguments are used to justify that. It is said, well, bondholders, go and ask anyone in the financial industry, what do they discount payoffs with? By the government interest rate, ergo M is R, ergo this term is zero. That is a logical fallacy, because you're going around in circles. They use the R to discount other payoffs, to discount the debt itself. You can't use the interest rate on the debt itself, or at least not as a logical statement. Okay? Instead, this mysterious term has been studied in economic theory, and for a long time throughout the 1980s and 90s, we'd called it a bubble. We'd write it, instead of those terms, we'd write it as a limit condition of debt at infinity, if you have seen that. More recently, though, this has been known as the present value of a convenience yield. We think about the government debt as providing some convenience of some kind. That means that holders want, that therefore provides a service to its holder that they're willing to pay in the sense of tolerating a lower return than their discount. But I think a more general statement, and one that theory, especially in the last 10, 12 years, has supported, is to think about all the possible services that debt provides, its safety relative to other investment in the economy, its liquidity in a world of financial frictions that needs liquid assets, or even the fact that in a world with many financial frictions and incomplete markets, public debt provides a role of agents as a store of value that provides some self-insurance, and which is valued by agents, leading them to accept, again, an interest rate that's lower than the discount rate. How large is this term? Well, the literature has been busy trying to measure it, and from extreme versions where the great difficulty is, what is the discount rate? And again, you can't just look at financial markets and say what it is, because that is a circular argument. One way is to think, for instance, at what is the interest rate on a very macro perspective. Let's look at what's the return on the capital in the economy. That's the alternative. You either hold government debt or overall capital. That leads to the green line there, where the red line is the interest rate on the public debt. And another approach is to instead use the interest rates extracted from financial markets that we use in finance altogether to evaluate different portfolios in terms of the combination of returns on equity and other assets. Either of these have led to almost absurd results because they are so large, where this unbacked debt accounts for numbers around 70 to 100% of GDP when it comes to the United States. In other words, the debt in the US is unbacked, for instance, by primary balances, which are forecasted to essentially be close to zero forever. And yet, why do we have 100% debt GDP? Because this term can actually account for something like 100% of GDP or not, okay? Having said that, and as a preamble to what will follow, that is shrinking. The interest rate on government in the US has been increasing quite significantly in the last 2 years. All of you know that. But what most of you may not be aware of is that either the returns to capital or the returns to equity or corporate bonds and other investments in the economy, the alternative to public debt, which somehow will capture this discounting by investors, has not increased in the last 2 years. What we've seen in the last 2 to 3 years is a shrinkage of this M minus R. What we've seen is a shrinkage of this mysterious convenience yield bubble term that means that the US debt is now highly unbacked. And that is true, it is true especially dramatically for the US, but is also true for most European countries and others. Let me introduce a central bank, since we are at a central bank conference. Let me go a little faster, perhaps, since this should be more familiar, and where again, all I'm doing is accounting. You look at the bonds held by the central bank and subtract from it the reserves and currency, and to a first approximation, what you have is a change in the net worth of the central bank. Well, how does the net worth of the central bank changes? It changes given the returns it has on its assets. It gets subtracted by whatever transfers are sent to your treasury. And finally, you must pay interest on banks while earning the inflation tax on account of the currency being a nominal liability that loses value relative to the other real assets that I put there in real returns. That's just, again, the balance sheet of each one of your institutions for the central bankers in the room. Integrate that, just as before. But now I don't write the math not to scare you, but it's exactly the same math as of 2 slides ago. And what is the unbacked debt when you integrate and combine the central bank with the government? It's again a present value of this debt held, privately held by non-financial intermediaries, but now has 3 extra components. First, the bank's holdings of the public debt. If they're again willing to accept a return R, that's not the same as the discount rate M. Where does that term, well, so second. Third term, it's the extent to which reserves deposited in the central bank, the debt of the central bank itself pays a very low interest rate relative to alternatives in the economy. And thirdly is the term that for decades or centuries we have called seniorage, which is the result of having a steady persistent inflation says that inflation plus that discount rate, what sometimes is called the nominal interest rate in the economy, times the currency, provide a gain to the central bank in giving, again, this inferior asset currency that pays a terrible return, zero in nominal terms, when there's nominal returns out there in the economy. Fine, that is the accounting of the government. But what is then financial repression? Financial repression is, in the context of governments, like most governments today, certainly advanced economies have, a large unbacked debt. If I were to show you pictures, and I had them but cut them for the interest of time, of how much unbacked debt there is across the G7, every country has large extents of unbacked debt, given forecasts for the primary surplus and their current level of debt. Having told you how the literature has tried to measure and explain what is backing that unbacked debt, financial repression is understood as the government, through policies, systematic policies, trying to, perhaps artificially, perhaps in a way that proves to be counterproductive or leads to failure, attempts to raise these terms. Under forcing banks through regulation to hold government bonds creates a demand for those bonds that lowers their return relative to the discount rate, that creates a revenue, a backing for the debt. Not paying interest on required reserves is a way to tax the banks if you want, but again, tax may not be the right word as much as it is financial repression the right word, is accepting an asset that has an inferior return. And finally, currency, of course, the best well-known, one that we've known since at least the work of Philip Kagan, if not before, and which every well-trained economist in Latin America knows about, is again the repression of paying no interest on currency, and therefore having people who have to hold currency to pay their debts to the tax authorities and to conduct their transactions in an economy, and yet be hurt by the high inflation that represses those holdings. These measures of domestic repression have some classic counterparts. An extremely famous paper by Alberto Giovannini and Sandro De Mello solved the measurement problem by saying, let me look at the interest rate governments has to pay abroad compared with the interest rate that governments have to pay domestically, on the bonds held domestically versus bonds that were issued at times by different countries to hold by foreigners. And let me try to multiply and figure out how large is the revenue from what, in my notation, would be just the first term, the underpaying of the government bonds. And they came up with, and they showed that the repression was considerable, a percentage of GDP that were around the 1% and the 6%, depending which country it was. And this was the scores of the 70s and 80s that, as many will know, Governor Julio certainly knows, led to the financial liberalization agenda of the 1980s and 90s, as it was appreciated the extent to which financial repression was an important part of the revenues of governments that came with many distortions. Giovannini and Mello themselves noted that part of this came from the doom loop, the large share of government bonds held by deposit banks. But by noting that, they made two observations which I think are very relevant today. One, that repressing financially the banks must follow, the analysis of that repression must follow the principles of tax incidence and ask who ultimately bears the cost of it. And very often when it comes to repressing banks, banks will pass that cost to depositors by paying themselves a low interest rate on that. And second, that seigniorage, inflation, comes hand in hand with financial repression. They are not substitutes but complements, a point often forgotten in theories, but which even themselves, Reinert and Rogoff, highlighted, because this time is not different, that seigniorage and this financial repression are positively correlated in the data, and they tend to be, that countries both will use repression and inflation as strong complements in doing so. But let's turn to international capital flows. In the international literature, there's also risk constraint. The net foreign assets of an economy will grow by the sum of the trade balance and the return on those net foreign assets. But being an accounting identity, a budget constraint, just like the one that I showed you for the government, it means that for the country, as opposed to the government, there is also an unbacked debt to foreigners equal to just the same present value, but now of the debt, the negative net foreign assets, times the gap between what is paid by the government and what investors in general would require in a free, open market for those investments. In the international macro literature, this term has been given a very famous and very different name. It's called the exorbitant privilege. Researchers have been busy measuring it. On the left are some measures, some very famous measures by economists Conferencia and Reis, and on the right, some updates by also famous economists Atkins and Ithko and Perry, that much like with the revenue literature that I told you on the specials of government bonds, has also been trying to see how large this term is, and agreeing that it was large for some time. It seems to have shrunk quite significantly in the last few years. So sometimes it's positive and sometimes it's negative. Importantly, that literature has noted one thing that I must clarify before moving on. I've been talking about repression as systematic policies that back the debt of a country and of a sovereign by systematically underpaying your liabilities relative to what is the alternative that agents would require in any other investment. That is different from what you may call valuation effects, although the literature often uses that same term for the two things. And that is that the market value of the debt is itself equal to past commitments times the price, the market price of that debt, times some exchange rate in international context. So when we do policies, let's not be too hypothetical, when we have President Trump announcing a series of tariffs and that causes a depreciation of the currency, that is a market revaluation of the foreign assets that the US has, or in this case, the net foreign liabilities that the US has. That is not repression. Maybe if you want, it's unexpected repression, but that is a market adjustment of an equilibrium price to what are other policies, okay? The returns to the holders happen to be unexpectedly low, but where sometimes they are negative and sometimes they are positive. As anyone who deals with exchange rates knows, sometimes they unexpectedly appreciate, sometimes they appreciate. Perhaps an analogy familiar to central banks is a useful one. There is a big difference between seigniorage, what you collect on currency by persistent, steady-state anticipated inflation, and inflating the debt, meaning unexpected inflation that lowers the real value of the debt. Or in nerdier terms, Sargent and Wallace are not the fiscal theory of the price level. These are very, very different theories in terms of what they focus on and what they imply. In the international context, how has repression worked? Let me tell you some examples, if you want, that may be illustrative, that are perhaps a little more novel or a little less appreciated. What I plotted for you there is the network of swap lines and repo lines established by the Federal Reserve with countries all over the world. In blue are the direct connections established by the Federal Reserve, whereas in lighter shades are instead the indirect connections that are formed when the Fed has a swap line with ECB, and the ECB in turn has a swap line with the People's Bank of China, implying that through an argument of arbitrage, Chinese banks actually have access to dollars insofar as they can just tap in a swap line that the PBOC has at the euro area, use for markets to exchange for dollars, and have the intermediaries in that use that connection as well. In 2000, this provision of swap lines is a provision of the international lender of last resort, an important one, a crucial one, to keep the liquidity of the US dollar, or the usefulness of the US dollar. But what did US authorities do in 2020? In 2020, as opposed to expanding more some of the swap lines, the Federal Reserve created the so-called FEMA repo lines. And what were those? Instead of simply being able to borrow dollars, in the case of the ECB, say, and giving euros as collateral, you now had to deposit treasuries in order to get your dollars as an alternative. For many purposes, this is equivalent. But at the same time, know what that does. That says that you need to hold the treasuries, even if they give you an inferior return, for the eventuality that you will need to have access to this lender of last resort by the Fed. The FEMA lines are a form of financial repression when compared to what a swap line was. Repression, again, doesn't mean just forcing you to do something against your will. It also consists of providing service that is important to you, but making regulations, requirements, in this case, having a stock of treasuries in order to do so. The Federal Reserve didn't do this with an intent of repressing. It did it to help the treasuries, but what was help the treasuries? Helping the treasuries was nothing but, again, keeping the treasuries from losing value, giving returns, losing their specialness, keeping their liquidity in speeches, which is nothing but increasing precisely that present value of unbacked debt that authorities were very worried about. So, in a subtle way, the move from swap lines to the FEMA repo lines, and I mention this because just in the newspaper 2 days ago, maybe it was yesterday, I lose track with the traveling, there was an article in the Financial Times about serious discussions about canceling the swap lines. Perhaps the US will not stick by them. Nervousness among central bankers all over the world. Note, cancel the swap lines, yes, not the FEMA repo lines. And certainly it will be said, well, these are the same, but they're not. One has a repression element and the other one does not. Second, the talks, and again I use here recent clipping from a few days ago from The Economist, of the idea of taxing foreign investors. This is of course a much more classic way of financial repression, but it's a classic way of financial repression insofar as using the depth and the special nature of the US financial markets, the US is able to impose a tax on any investors in its financial markets. And how much damage could that do to a global financial system that depends very strongly on the US financial system at its heart? Let me move away with this because this was perhaps the least surprising. Let me talk about a third one though, that is again a little more subtle and sometimes underappreciated. We have understood over the last decade in theory, and people like Governor Velarde had understood this much before, this was the case where practice was ahead of theory, that exchange rate interventions and others, by shifting who bears exchange rate risk in the economy, can be effective. There is a limited ability of intermediaries and others to hold exchange rate risk. And as a result, exchange rates have to be managed. Nowadays, we'd call it the integrated policy framework, to use the IMF's words, okay? What that implies is that, a great evidence for that comes from that picture on the bottom right, which is you have a carry trade to compensate intermediaries for this willingness to absorb some of the exchange rate risk. And whenever we have a massive increase in risk, a massive contraction on their ability to do so, as captured by those two big crashes of the financial crisis and the pandemic, you see an immediate shift in the carry trade, which is a very simple form of evidence to describe how limited is the risk-bearing ability of a financial sector. Well, in this context, because the US, the major financial intermediaries in the world are US institutions, which as we see are susceptible to the pressure from their government, and we see how much the US administration has been pressuring their tech companies and other companies, a form of maybe more subtle financial repression is the extent to which the administration can put pressure on the major financial intermediaries in financial markets, which are US institutions, in their willingness, given their limited bearing capacity, to divert their risk-bearing capacity away from exchange rates, and in doing so, lead to inferior returns in the sense of UIP deviations, if you want, but interest rate differentials on foreigners holding US government debt. What about repression with respect to domestics? Let me give you all know again about required reserves. We all know about forcing banks through regulation. Let me give you a more modern version of that from some work that I've done in the last few years in trying to make sense of the way that China engaged in financial repression. Chinese households are limited in their ability to consume and have very large savings rates, and those saving rates are highly controlled to stay domestically in part by the authorities, who then want to control the capital outflows in terms of where savings of China, the country, are placed abroad. How have they been able to do this in an economy that is very large, the largest trade in the world, that has a massive current account deficit that by the rules of international macro imply very large capital flows abroad? How can you control the ability of domestics to simply invest abroad, to search for higher returns, as opposed to simply saving in the repressed returns of the Chinese state banks especially, as well as government, who then directs those abroad. Well, the way the Chinese have done this, have solved this conundrum, is by creating a parallel currency system. There is a mainland currency, the CNY, and there's an offshore currency, the CNH, often associated with Hong Kong, but not only, such that the way capital controls are implemented is by tight controls on how you convert CNY for CNH. How do you do capital controls? Well, in many countries, in Latin America, the experience is that when someone is trying to exchange dollars for pesos, is at that point that you put the controls by controlling the few banks where you can do that exchange. Well, likewise, the Chinese are following that time-honored strategy, but had to do so by creating a foreign currency in itself, a set of banks that do those conversions. What they have done de facto is legalize the black market, where if someone wants to move money between abroad and internally, in either direction, you need to convert CNH for CNY, but instead of there being a black market exchange rate between the two, there's an official exchange rate, official in the sense of a free market exchange rate, where the authorities intervene frequently in order to keep that exchange rate pegged, and therefore prevent there to be such a gap between the black and the official exchange rates that the principles of Gresham's law will lead to a collapse of capital controls. I want you to use the CNH-CNY apparatus. I cannot let the peg between them diverge too much or in any persistent way, because if it did, you'd have an incentive to find other ways, illegal ways, to evade the capital controls, truly black exchange rates, and then I would stop being able to control them. The CNY-CNH peg, there in the middle figure, is one of the most successful pegs of the last 20 plus years, and it does so, as shown in the bottom right figure, because whenever the CNH appreciates, the PBOC prints money in order to, through classic quantity theory principles, be able to devalue the value of the currency. Well, how has that worked? Not only has it worked as a system, but how has it worked as a system of repression? In the summer of 2023, there was a devaluation of the renminbi relative to the dollar, having to do with differential opening in the pandemic. And as the PBOC tried to use repression to stop a too fast devaluation, we had the repression showing up in terms of precisely the pressure on this valve of the CNY to CNH to US dollars. Because if you want to buy dollars, you have to go through this in order to move abroad. The spike in interbank rates between the two supposedly equivalent currencies, because one CNY and one CNH are supposed to be as one, became considerable. It jumped by 2 or 3 percentage points. The exchange rate deviated from one, was always below it. But this system of repression, with these two very clear measures of the extent of repression, worked its magic and did its operation in terms of, in this case, a desire to intervene in the exchange rate, but likewise also with fiscal implications in the financial repression sense. Today, for all the talk of there not being an alternative to the US dollar, in the oil market, sanctions over Russia, Iran, and Venezuela mean that numbers of somewhere between the lowest I've seen is 5%, the highest I've seen is 20% of oil sales in the world are now done in CNH or in renminbi, therefore opening this room for this repression. But can you repress, though? I've given you examples of repression. I've given you a definition of repression. For repression, though, it must be that the domestics or the foreigners accept a lower return. Again, that was the definition of repression. That was the goal of the first 10 minutes of this talk, for us to understand exactly what the repression is. Note that all of those terms have a similar structure, a wedge between returns times the holdings. And once you realize this structure, you right away recall your public finance classes and see that this is just like a tax rate times a tax base. You're implicitly taxing the holders of your government bonds. And then you realize that your ability to do this, it's not enough to show you the examples I showed you earlier, but rather you have to ask, what's the elasticity of the base to the rate? If whenever you try to financially repress, everyone moves away from your liabilities, then you won't be able to repress at all, or you can in paper, but without that generating any revenues of any kind. What is that ability to repress? Let's start with the small open economies, such as the ones in this room. I think a wonderful example comes from this classic paper by Marco Chamon and Marco Garcia on looking at the capital controls imposed by Brazilian authorities starting in around the 2009s and 10s, and what that implied for precisely a measure of repression in the sense of a gap between M and R, in this case an offshore and an onshore return on reais. And what they showed, and I think at the time was quite surprising, is that initially you certainly see an impact of all these Brazilian capital controls, but it's remarkable how their effect dissipates within a few weeks. That foreigners, domestics, adjust their portfolio holdings, find ways around, and your repression term closes down very quickly. In other words, that the ability of a small open economy to engage in repression is quite limited because investors, foreign investors at least, will come up with alternatives very quickly. Of course, you can engage in domestic financial repression. And here I go back to the initial estimate, the experience in so many countries, including the ones in this room, of the 1970s. You can indeed engage repression. I already showed you the one set of estimates. Here's another set of estimates of how much in the post-World War period we engage in domestic repression to pay for the debt. But, and here, with this audience especially, and with enough wise people in the room, I don't have to remind you why we did the liberalization of the 80s and 90s. It's because that repression was very costly in terms of the welfare cost it had on cost of credit, the corruption with financial repression, the rise of conglomerates in their internal capital markets, as well as the nominal distortion associated with inflation. But what about the US? Let me end where I started, with a president or an administration in the United States that is willing to enter trade wars, is willing to foster fragmentation, and would be very willing, I think, I started with engaging in financial repression in order to sustain its debt and to back its debt. A well-reported fact is that there is indeed a specialness of US bonds, expressed here by this downward sloping supposed demand for US government bonds, from classic work by Arvind Krishnamurti and Edwin Jorgensen, showing that, yes, indeed, it's not infinitely elastic. It's not a horizontal line. There's room here to tax this demand for bonds, to exploit it. I would note that that specialness has been quickly eroding. On the right is a plot showing the covariance, the daily covariance between US treasuries and stocks, and showing how quickly they started becoming a very negative risk, and how in the last 2 months you have had that, if you were to estimate again this subject limitation of having 2 months of data but at a daily frequency, all of a sudden you would find that the bonds in the US have really become much more elastic in terms of their demand, that ability to engage in repression has fallen. What about required reserves? People will likewise point to important work trying to estimate the extent to which there's a downward sloping demand for reserves by the central banks, allowing you therefore again to engage in repression. And yet, and this is from some work I did earlier, if you look in the US, and this has led to a modern version of this, which is to say, aha, I can pay interest on excess reserves while paying no interest on required reserves. And in doing so, keep control over monetary policy while taxing inframarginally the banks for their holdings of required reserves. At the margin, I will still have the interest on excess reserves to control monetary policy, but I will tax the banks on their required reserves. Not so fast. If you look at the distribution of reserves in the United States, what you see is an enormous variation in the stock of reserves that each one can do. Yes, they all now hold more reserves, as in the plot on the right, but that holding of higher reserves, in part because there are more reserves in the system and markets must clear, hides an enormous variation. A central bank that gets too clever and thinks that I can simply set the right level of required reserves, pay nothing on them, or even charge a fee, why not, while still having control of monetary policy through the interest and excess reserves, I will boldly conjecture that it will find itself actually setting required reserves that are too high for many banks, and in doing so will actually interfere very strongly with its monetary policy goals. It will have a lot of trouble controlling inflation while attempting to engage in this repression. Finally, and one more point, although I'm out of time, but I'll abuse the moderators by 1 minute. The elasticity itself is endogenous. Meaning, as you try to abuse the financial repression, that elasticity becomes higher. The classic example here is the euro-dollar market, a story that, again, many forget because it was already 50 years ago. But when the United States tried to engage in very active financial repression in the 1970s, what you had was a dollar market arising in London that allowed nothing but a way to evade that financial repression while engaging in dollar credit. A legalized and tolerated black market, if you want, which is nothing but, in taxation formula, an increase of the elasticity. Today, people talk about stable coins as perhaps the new eurodollars. Like them, they are small today. Like them, they could grow up quickly. And like them, they are a means to avoid financial repression. I am skeptical, but I'll leave that for the discussion since I didn't manage my time properly, if those of you ask. But to conclude, I try to make the following points for you today. There's reasons to expect a return of financial repression. We have very large unbacked government debt, a retreat from globalization, leading to a desire to why not just tax trade flows, but capital flows. We have capital controls and macroprudential policies now well established as part of integrated policy frameworks and therefore ready to be abused. And we have these exorbitant privileges and unbacked components disappearing very quickly. Financial repression is nothing but a way to try to bring them back. The historical experience of small open economies is that you can do domestic financial repression at a large cost, that is at least as large as that of direct taxation, and then international repression is very difficult. I then try to show you how domestic novel ways of repression, from liquidity lines to offshore currency pegs to information required reserves, are more limited than they're expected. And likewise, that the US attempts may prove fruitless. And I leave that as a warning sign, for even as I said, I want to look ahead and think of financial repression coming, I do worry quite strongly that 10 years from now, much like we did in the 1980s, looking back to the 1970s financial repression, we'll realize the mistakes of the ways doing that. Thank you very much.